Good evening, all the Chinese. Thank you for joining in. This is Prajakta. I would like to warmly welcome you all on behalf of NGEN Research. Meanwhile, others join, let us introduce the topic for today. Our webinar related discussion is going to revolve around performance comparison of mutual funds. Typically, in the session, we are going to have a look at the newly introduced query tab that we have introduced in the funds screener section. Of course, initially we will understand how do we traditionally using the good old screener specify basic filter parameters to actually screen funds, and then going a step forward we will use the query tab and write multiple conditions with which we want to then screen and actually select mutual funds, and ultimately take them to the compare section for further analysis. That's part number one during the entire webinar session. Next, we will understand how we can use multiple parameters like standard deviation, or for that matter, up capture and the down capture ratio to compare the performance of different mutual funds, one with their respective benchmarks, and number two with their respective category averages. So, if we load large cap funds, we will see how we can add category average of the entire large cap universe as a row item, and then see which funds from the list actually manage to outperform the large cap category average and which do not, right? Next, we will then move ahead and understand risk and return scatterplot, risk versus return scatterplot, which is there on the NGEN Markets Compare section. And we will see how the positioning of the fund's risk and return statistic changes over time, right? And we'll understand how you can use this particular tab to get a bird's eye overview and actually take decisions basis the risk and return statistics of each of these mutual funds. Lastly, we will open the forum for a Q&A session wherein you can get your questions answered by either unmuting yourself or directly typing in your questions in the chat box. So let's now begin. Initially, when we are going to screen funds, right? We'll go the good old traditional way, wherein this is the NGEN Markets landing page. And typically for screening funds, we always go to the funds section screener tab, right? This is the first tab in the funds section that's called screener. The moment we land in here, you will see first filter categories, right? The moment you click on this, a small window opens up which has four different buckets: equity, debt, hybrid, and others. Different subcategories are listed in each of these buckets. Now, let's say we want to analyze all the flexi cap funds, right? Then we just choose flexi cap and then hit close. This will say that, okay, this is one active selection that is made by you, which will ultimately give in the results, right? So we have chosen all the flexi cap funds and we click close. We see there's a list of 39 mutual funds that appears right here in front of us, right? Now, let us sort them on the basis of, or rather, let us customize the view in such a manner that only relevant columns are visible, right? Because these flexi cap funds were from equity as a asset class, we are going to use this drop down to change the preset column views to only the relevant equity columns only, right? Currently, you see net YTM, average maturity, the durations, the credit ratings. All of these are not really relevant columns for analyzing equity funds, right? So all of these redundant columns will go away, and the moment you change it to equity columns view only, all the relevant columns only show up, right? So this is a list of all the relevant columns that we are going to use, or rather we can see on the basis of which we can use to sort these flexi cap funds. Now, let's understand what are the filter parameters that you can put. The first filter parameter that you can do, or that you can use, is the AMC filter. You can see that right below the filter categories. You can click on this, and typically you can select everything and then just unselect whatever AMCs you want to exclude in your selection. For the time being, I'm not going to use this filter. I'm going to keep all the AMCs selected. Of course, it could work either ways. You either select all and everything will be selected, or you just do not select everything. In spite of that, everything will be selected as well. And this is clearly mentioned, so nothing is selected. We are showing all AMCs. Right now, on the basis of AUM of each of these funds, let's say we want minimum AUM as 2000 crores and above, right? So we put minimum AUM as 2000 and then we hit apply. Now, our universe of previously 39 funds has gotten shortened to a list of only 23 funds, which are really meeting or agreeing to the parameter that we have set. Right? Of course, this was a very basic filter parameter, and this is the only condition on which we were sorting the funds. With now, if you want to go a little one step forward, and we want to say that okay, I want only those funds who have been around for a period of at least 5 years, right? Then you go here in minimum age as a parameter, and you put minimum age as whatever is required. So let's say 5, and you click on apply. Right? This is how you can further shorten your universe to a list of 18 funds. Right? Now, these were basic filter parameters, and of course, then you can take all of these funds to the compare section for further analysis. This was our good old traditional way. But now, let's say you want to build in some complex conditions. By complex, I just mean that you want to add multiple layers to these sorting, and you want to take a customized list only to the compare section for further analysis. Right? Then, what comes to your rescue is the query tab that we have recently introduced on NGEN Markets. First of all, let's understand where do you locate this query tab. This query tab can be found right beside the screener section in the funds section itself. Right in the funds section, the screener beside that on the right hand side, there's this query tab. You simply go there and you see a window opens up, or for that matter, the entire tab opens up, wherein you will see you can first select plans, right? So in this case, in the condition of, for that matter, the query that we are going to run, we are going to consider all the regular funds only, right? So I choose regular from the drop down. Next, the moment you click on select statistic filter, and the moment you click on this drop down, you will start seeing the entire list of column heads that you were seeing in the screener tab. Now, where are these column heads coming from? That's exactly the same column headings that you were seeing here. Of course, there is no specific view that we have enabled there. It's all columns that we can see, right? All of these columns will be available for choosing, or rather writing as a condition, this entire list. Right now, let's start basic. Right now, I want a list of all the flexicap funds. That's the same one that we did in the basic screener section. So what will you do? You'll say, okay, select statistic filter. Because it's a SEBI category, you will choose the third option, SEBI category. Right, the moment you choose that, what is it in the category? So we saw a list of 4 buckets that opened up in the screener, right? But in this case, there's no buckets. It is going to open a list, right, across all the asset classes. So it will be equity, debt, hybrid, others all together. Now we were going to load flexicaps, right? So let's just search for it. Of course, it is anyway arranged alphabetically. You can definitely scroll down and find flexicaps, but we've also enabled the search, right? Just type first 2 letters and it'll show up, right? So flexicap funds is what I want. And the moment you choose, okay, so this is what I want, flexicap. After that, you have to click on add condition. The moment you hit on that, it will say, okay, all the 39 funds from the FlexiCap category have been loaded in this particular query tab. If you want to see where these funds are, you simply click on show 39 funds. This was a list of 39. So this says found 39 funds. And if I want to view those, you simply click on show 39 funds. This is a list of all the 39 funds from the FlexiCap as a category. Right now, let's go a step further and let's add another category here. Right, along with FlexiCap, let's say before applying filters, you also want to add in value category funds. Right now, the procedure will exactly be the same. You'll not change anything here because today we are analyzing all the regular funds only. In the select statistic, it's anyway SEBI category. Now you'll go on the drop down and you will say, okay, value is what is the category that I want to add to this list of FlexiCap. So value is what you will load. The moment you click on that, again, you have to hit on add condition. Right now, please pay attention here on the logical operator. The first condition was FlexiCap, and the second condition is value. But it says zero fund founds, zero funds that have been found by this particular tab. Why is that so? Because the logical operator that we are default using is and. There cannot be a fund which is a FlexiCap and a value category fund. It has to be either or, right? It's a mutually exhaustive, kind of a definition that we are mentioning here. So we'll have to change the logical operator from and to a or. The moment we say or, it will typically given or rather throw in increased list of funds which are either flexi cap or value, and that is exactly what we wanted. Now we see 59 funds is what the query tab has found. That is of course more than the flexi cap list. So value category, entire value category funds have been added to that. Now if you want to see all of the list here, you simply show, you simply click on show 59 funds, and this is how the funds get shown up, right? So there's a list of flexi cap and value, right? Now let's increase the complexity a bit. First, let's add one condition, which is to say that, okay, I want to have a look at only those funds who have typically or other who are not very young, right? So typically I'm going to put in minimum age here, and I'm going to set in a range. I do not want very young funds, but I do not also want funds beyond 25 years into existence, right? So then what I can do is, again I go right here, SEBI category, and I say age is what I want to sort this on. So that is typically launch date. So I'm going to say, okay, funds that have been launched, after, let's say, 2000, right? That's the range. So this is the oldest fund that we have in the list in the value and the flexi cap category, 3rd of March 1993. And the youngest fund in this list, of course, I mean, that's yesterday's date. That's there by default, right? You cannot have a fund that has launched even beyond this date, right? And between, I do not change the date here. So I say, okay, add condition. Now, please note, when we are saying, okay, I want a fund that is launched between March of 2000 and the 29th of March 2024, I want this filter to apply to both the categories, right? I want flexi cap or value funds between this date. Therefore, we'll have to apply some brackets logic, mathematical brackets logic right here. So bracket opens at flexi cap and bracket should close at value funds. We have to consider both of these funds between 2000 and 2024, right? Therefore, bracket open is correct. The bracket has to close only after the value condition is added. Therefore, we'll have to remove these brackets from here, right? So bracket close here has to be removed and bracket open here has to be removed. Now, the big bracket, meaning the big universe is flexi cap funds and or value funds between 2000 and 2024 is what is the list that we have customized. And there are 51 such funds that predominantly lie in this particular range. Now we say, okay, show 51 funds. There's a list of, the moment you do that, you see launch date is something which is a indicator of age. That is what gets populated here. Okay. Now let's now please note, we missed here. The logical operator we used here was and. That's because we want either of these two funds categories and this condition to be satisfied. Now we are going to try and make this a little more complex by adding some quantitative parameters. Now let's say we want to have flexi cap and value category funds who have a very decent large cap percentage, right? This is another condition that we have. Let's say large cap percentage that we are going to target is, let's say, between 50% and 100%, right? How do we add that condition right here, right? So we say from this drop down, large cap percentage, that is what you can find. You scroll down and locate large cap percentage. You click on this and this, its minimum and maximum will get open. As is the case, the minimum large cap will be 0 and maximum is 100. So now our condition was to get flexi cap or value funds which have exposure to large cap between a 50% and a 100%, right? This is the condition that we were looking at. The moment we specify our parameters, we say add condition. Now, again, here it will be a logical operator and only, because we want the funds to comply to both of these parameters, right? Minimum age as well as large cap percentage. And we see from 51, the universe has further gotten reduced to a list of 39 funds. Let's go a step further now. Now I want to cap the volatility that I can see of each of these funds. I want volatility between volatility meaning a measure of risk, right? Which is measured by the standard deviation of each of these funds. I want to cap the volatility between a range of 10 to, let's say, 25, right? Then we can do this exact same procedure. Go to select statistic filter and now we will choose volatility, right? The moment we do that, minimum and a maximum range comes in. We are going to say that, okay, my volatility target return range, my acceptable return range is between a 10% to, let's say, a 25%. And I say add a condition. Again, the logical operator is going to be and, because we want all of these conditions to be satisfied. Again, you see from 39, the funds have gotten reduced to a 36. The moment you click on show, all the parameters that you add as conditions are going to get added here. Launch date was first, large cap percentage was second, and volatility was the third condition that we specifically added. That was between 10 and 25. You'll not see a single fund which has a volatility beyond 25%. Right? Now, if we were now, let's add a parameter which is value at risk. Value at risk typically is an indicator of the downside risk that a fund has. In order to understand value at risk, before adding that as a parameter, let's understand value at risk, what that means in a specifically new tab. For that, I'm going to load in a particular fund. So let's say a HDFC FlexiCap, right? The HDFC FlexiCap funds value at risk can be located right here when you scroll down, which is to say, what is the value that is invested in a particular fund that is at risk. At risk of what? At risk of losing. Right now, this we are saying this with a 95% confidence interval, which is right here, which is mentioned right here. Now, with the 95% confidence interval, we can say that there's a 5% chance that this fund has given a loss, which is as worse as a negative 32.56. On the other hand, simultaneously, if the same amount is invested into benchmark, it has gone down further worse. It has recorded a loss of a negative 34%. That means your fund is slightly better than the benchmark when it comes to a downside risk. In other words, what we can understand this as is if 100 rupees is simultaneously invested in the fund, which is the HDFC Flexi Cap, and the benchmark, which happens to be, in this case, Nifty 50, then my 32 rupees is going to be my capital that will be eroded, right? And the capital that will stay intact is a 68 rupees in the case of the fund, right? On the other hand, in the case of my benchmark, the same 100 rupees, the capital that will stay intact is going to be 66 rupees, right? And the balance 34 rupees is going to be my capital that will be lost, right? The eroded. This is the explanation of value at risk, which is a measure of downside risk that is there in a particular fund. Now, HDFC FlexiCap funds downside risk happens to be between 32 and 32%. And if we want to cap this particular value at risk of each of these funds, right, then we go here and say, okay, value at risk is what we were looking to cap. So we choose historical 95% implied, historical 95% value at risk as a parameter. And this is the range that we are looking at, right? So I want to cap it between, let's say, a negative 40 is my tolerance level, and which can go down up to negative 25, right? The moment this is done, again, the procedure remains the same. I say add condition. Now, these are the list of 6 conditions that we have added. We have taken 2 categories. We have taken launch date, meaning age. We've taken large cap percentage. I want larger percentage into large cap. That's between 50 to 100. Because all of these are flexi and value cap funds. Volatility is between 10 to 25, and the implied value at risk, that's a measure of downside risk, is between negative 40 and a negative 25. Right now, I see a result of 13 funds, and we have built a set of very complex, or for that matter, multiple complex conditions to this. Right, the moment you see this here, you say show 13 funds, and a list of these funds open up. So we have a diverse set. We have some flexi caps, we have some value. Right now, please note the value at risk numbers that you see right here are always since inception of the respective funds, right? You could even see that here, because we even say in the screener tab also, the value at risk number that you see here are always since inception. For example, we were looking at HDFC Flexi Cap Fund, right? HDFC Flexi Cap Fund, if you have a look at the value at risk number, which is right here, that's a 32.56. And this is the value at risk number since inception, right? This is matching. But the moment, because if all of these funds are not comparable, right? Because these have different inception dates. The moment we change in the start dates, all of these numbers, sharp ratios, or for that matter, value at risk, or for that matter, CAGR returns are going to change, are subject to change, right? Now, in order to compare them, fairly with each other, peers to peers comparison, we have this option to take the entire list that we have currently loaded to the compare section for our further analysis, right? This was the list that we had, 13 funds. You click on show. This is the list that we had. And then we take them to the compare section by simply clicking on this icon. Take all of these funds to the compare section. The moment you hit on this, list of 13 funds has gotten added to the compare section. Now, please note here, before proceeding, let me highlight that you need not build all of these conditions every single time. Let's say these are the set of conditions that you want to, follow. Or for that matter, these are your go-to conditions for, let's say, a list of particular categories of funds. Or for that matter, for all of the funds from FlexiCam value, this is the conditions that you're going to follow. You need not load them all every single time afresh. You can typically save this query with these condition, with these logical operators, and with the brackets logic that we have really used, right? So need not apply your brain every single time. Once you apply, that's it, right? And then you say, okay, save this query. Of course, you can name the query as what you require. So let's say this was a logic that we used to, sort flexi and value, right? So we say flexi and value. You say save query. This will be saved right here in the load saved queries tab. Now let's say you log into this particular platform after a couple of weeks, right? You have nothing right here, right? Nothing is typically there in the query tab, and you want to typically go and check what was the query that you used the last time around. You simply go to the queries tab, you say okay, load saved query, and you simply have to locate the name that you had saved. Of course, the date also comes in, so that's 31st May 4:26 p.m. is what we saved this. You click on this, and along with the brackets and along with the respective funds that adhere to these conditions show up, right? So need not repeat the efforts again and again. And then you simply say show 13 funds. In addition to taking them to the compare section, you can also save them into an Excel sheet and keep them for your record. So that is also possible. We have enabled the Excel download option right here. Now, once this entire queries and how to use this queries tab discussion is clear, let's move to the second part of the webinar discussion, which revolves around performance comparison of these mutual funds that we have already taken to the compare section. So we have a list of, as you can see, we have a list of some flexi cap and value category funds. Now, the first thing that we'll go do when you come to the compare section is you'll change the start date. That's because these funds, of course, have different inception dates. We want to compare it from a fair point of time, right? In a fair manner. So let's say we want to take this as a 5 years period. So 2019 is what I take. Let's say 20th of May, and I click on go. So this is the 5 years analysis that I'm doing. Now, on an absolute basis, the returns of each of these funds for the 5 years period that we are considering, if you want to check that, you simply click on this cumulative return column. This will give you absolute point-to-point return of each of these funds, right? So in this case, you see Quant FlexiCap has given the highest cumulative return. That's 298%. Right. On the other hand, we have a very, very young fund, that's Helios FlexiCap. It is given return 23%. Of course, that's also because it's a very young fund, 0.55 years only into its existence. Right. Now, on the other hand, this was, of course, a peers comparison. If we were to typically compare this with a benchmark, relative benchmark for the flexi cap and the value category is Nifty 500. And you can definitely check that by clicking on any particular fund, right? So you simply click on this particular fund, you will know the benchmark, right? So it's Nifty 500 for Nippon value, which is the value category fund. It's also the same for the flexi cap category fund. So you click on this and the benchmark for this particular fund opens up, right? So it's Nifty 500 itself. So comparable benchmark for both of these categories is Nifty 500. So if you want to add that as a row item to measure which of these funds actually manage to outperform the benchmark and which of these do not, right? Then you simply go here in the blue color coded columns, add other items, and you choose the relevant benchmark. So it's Nifty 500 is what we are going to add. And to differentiate the benchmark from the components, from the mutual funds per se, we've color coded that into blue. This was again a very recent update that we have done on the platform. We start we've started color coding the index into with a different color. Basically, it will be color coded as blue. This will help in easy differentiation. So now you see, you sort this, let's say, on the basis of Sharpe ratios of each of these funds. So you see, all the other funds apart from SBI FlexiCap and Bandhan FlexiCap, these are the only two funds that have Sharpe ratios which are lower than the benchmark itself. My benchmark's Sharpe ratio, that's Nifty 500's Sharpe ratio, is a 0.56. Now, what does Sharpe ratio mean? Sharpe ratio means risk adjusted returns. That is to say that the returns that a particular fund, or for that matter, benchmark generates per unit of risk that it takes. Right? So, higher the Sharpe ratio, the better it is. Right? So in this case, the benchmark Sharpe ratio is 0.56. On the other hand, the funds Sharpe ratio that lie below it, that's SBI and Bandhan, that those are underperforming funds when you compare Sharpe ratio as a parameter. Right? Moving forward, let's say now you want to add a category average and you want to check, okay, which are the funds that actually beat the category average as well when that is added. Now, we have two categories here, FlexiCap and Value. What I've typically done is I've deleted Helio's FlexiCap. That's because it was a very, very young fund. It was only 0.55 years. So in order to ensure that we're comparing good data, I have just simply deleted that. Right. Now I'm going to add in two category averages. The first is going to be value category average. So I simply type in value funds here and I click on this. This will again get added as a row item. Again, it being a benchmark, which is to say it's a category average, it will be color coded into blue again. This will be used as a differentiator. Right now, again, let's say you want to see which all value category funds are typically generating a higher volatility than my category average. You simply sort it on the basis of category average. That's, of course, standard deviation. You see, category average value is generating a standard deviation or assumes a risk of a 17%. All the other value funds that we have in the list, like Templeton, like Nippon, like Bandhan, right, have a standard deviation that is much higher than the benchmark itself, for that matter, the category average itself. On the other hand, we have a IPRU Valuable Discovery Fund, which is from, of course, the value category, whose standard deviation is lower than the category average itself. So let's say if you are recommending, or if you are willing, if you are thinking about recommending a value category fund to a conservative investor, or for that matter, a moderate investor, then you could typically go ahead and recommend a IPRU Value Discovery. That's because its risk is lower than the entire category of value category taken together, right? So this is one parameter that you can use. Again, you could, repeating the same process, you could also add in flexi caps category average right here. The procedure remains the same. You go here and choose flexi cap, and the category average of flexi cap gets added here. Again, now you can typically sort them, let's say, on the basis of CAGR. You can use either of these parameters. I have purposely used three different parameters to sort on the basis of three different indices. Right? For index, that is Nifty 500, we use Sharpe ratio. For category average value, we use standard deviation, which is the measure of risk. And now for flexi cap category average, I'm going to use CAGR as a parameter. So I sort them on the basis of CAGR. This is highest to lowest. Flexi cap category average is right here. That's 17%, 17.89 to be precise. And the flexi cap funds that lie above it, right? Which is to say quant flexi cap. And we have another, that's DSP flexi cap, that have better CAGR than the category average itself. On the other hand, HSBC, Canara Robeco, SBI, and Bandhan have a lower CAGR than the category average itself, right? So this is one comparative analysis that you can do along with a particular category's average as well as its benchmark. In addition to this, you can also view up capture and the down capture ratios of each of these funds to get actually get data for up capture and down capture ratios. We'll definitely understand what that really means. You have to scroll on the right hand side. The moment you start scrolling on the right hand side, you have to locate the pink color coded columns, which are called relative columns, because by the nature of it, up capture and down capture ratios are always calculated in consideration or relative to the benchmark, right? So therefore, if you do not have a benchmark that is added here in the relative columns, relative returns column, this data will not be shown up. This says, okay, this data is disabled. Please turn on relative columns. Only when you turn this on, the data will start showing up here. Now you have to be careful about the data as well, because you'll have to ensure that the benchmark that you choose is correct and relevant. In this case, it's Nifty 500. So we put the same benchmark right here. And also you'll ensure the start dates are same. For the returns of the funds, we had chosen 20th of May 2019 as the start date. So you'll go here in the start date of the benchmark and you will say that I want the same start date. Only then it's a fair comparison. So I will say, okay, May 20th, 2019. The moment I set in the data comes in. And up capture and the down capture, you can simply use this sorting tool to sort on the basis of ascending or the descending order. In this case, you see Quant FlexiCap has the highest up capture ratio. It has an up capture ratio of 136. Now, what does this up capture ratio of 136 mean? For that, I'm going to simply click on this particular fund. The entire detailed analytics of this particular funds open up. Again, if we have to match numbers, we have to ensure the start dates are similar. This is very, very crucial. So again, we take in the same date. So 2019, 20th of May. And the up capture ratio is right here. The moment you click on this I button, you say, yeah. So you see up capture, what does this mean? So this means that month on month data, it will be only those months will be shown up when the benchmark gave in positive returns. So for an example, in the month of May 2019, the benchmark gave a positive return of a 1.40. On the other hand, the fund went up by a 3.63%. That's definitely a better performance by the fund when you compare that with the benchmark, right? So it catches up better when the markets are in a bullish trend. Therefore, higher the up capture ratio, the better is what we call, right? Now, it is definitely going to consider those months as well when the fund gave a negative return. Why is why is the up capture ratio considering November 19? That's because though the fund gave a negative return, the benchmark gave in positive return. So it could be that case, right? The benchmark has given positive 1.30%, but the fund has given negative 0.92%. But that month will still be considered because what we are focusing on here is the benchmark. When the benchmark gives positive return, what is the effect of that up move on the fund is what is the meaning of up capture ratio. How much does it catch up when the markets are going up? On the exact opposite, exact contrary is the logic of down capture ratio. When you click on down capture ratio I button, you will start seeing those months month on month when the benchmark gave in negative returns. You will not see a single month here when the benchmark has given a positive return. That's the reason why we call this as a bearish trend of, for that matter, volatile times in the market. Now, when the market was volatile, how resilient was your fund, right? So for example, in the month of September 2020, right, the benchmark gave a negative 0.16 return, 0.16 returns. On the other hand, the fund gave in a positive 6.28%. That's pretty resilient. It's more than resilient, right? It not just did not give negative return, but actually given positive returns. That's definitely a good thing. Therefore, the target should be higher. The up capture ratio is what you would typically be choosing for a risk seeking, or for that matter, investor that is chasing returns. And lower down capture ratio is what you should be ideally choosing if the investor that you're catering to is slightly on a conservative or a moderate side. This is the meaning of up and the down capture ratios. Let's go back here. You can definitely sort this. So the lowest down capture is by a IPRO value discovery fund. That's a 64%. Sorry, 64 down capture ratio. Okay, so this is one analysis that you can do, and of course you can choose this for comparison with its peers. Now, once this is done, we will now move ahead and have a look at the last section of the webinar, which is discussing on the risk and return scatter plot. For checking the risk and return statistic, we have a separate tab on NGEN Markets Compare section that's called risk versus return. You can locate that right here at the center. The moment you click on this scatter plot will get open. This is divided into x and y axis. Of course, this is a graphical representation. So on the x axis, we measure annualized risk, which is to say that we calculate the standard deviations of each of these funds that we have considered. And of course, these are annualized always. On the y axis, we have annualized return, right? So if a fund has generated higher return, it will typically be plotted at a height on this particular y axis. right? On the other hand, if it has generated a lower return, it will be plotted on the lower end of the y-axis. On the other hand, if a fund has a higher risk, it will be plotted on the right hand side, extreme right hand side. Or for that matter, it will go on plotting on the right hand side, right? That means to say, okay, Templeton, Nippon, Quant have higher risk. On the other hand, if a fund gets plotted on the left hand side, right, that is an indicator that the fund has pretty decent or a lower level of risk. This is, of course, relative. All of this is in relative to all the funds that we have in the universe. In this case, we have 13 funds, and of course, one benchmark, one category average, and another category average. Basically, two category averages and one index. Right now, of course, this is from 2008 to 2024. This is the risk and return statistic, or this is the risk and return, positioning. But if you were to check how does this risk and return positioning change over time, you can simply change the start and end dates. So let's say we want to check this for a period of, let's say, last 2 years. So you say 2022, let's say, so 2 years exact, so 24th of May. Then you say, okay, 29th of May, and you hit go. The moment you do that, you see this positioning has completely changed. We have quant flexi cap, which was, plotted somewhere here, which has gone extreme up. That means this is a fund that assumes the highest level of risk, but it also compensates that, generating the highest level of return as well. Right? Its risk is 14.95, of course, annualized risk, and its return is a 32.56, again, annualized. On the other hand, we have a SBI Flexi Cap, which assumes the lowest level of, it generates the lowest level of return. We have another fund which generates which assumes lowest level of risk but generates decent return. Now, if you were to, typically choose between SBI and a iPro, right? You would typically choose a iPro over a SBI. That's because SBI definitely takes in lower level of risk, but not as low as ICICI, right? ICICI's risk is about 9.78. SBI is at 10.22. That's because ICICI has gotten plotted on the left hand side. But in spite of taking lower risk, it has generated better return than SBI, right? So if you have an alternative than SBI Flexi, which generates better return with lower level of risk, you will definitely go and choose ICICI, right? Of course, the choice will not be that simple when you're comparing ICICI with a quant. That's because quant's return is also good, right? If the investor is chasing returns, then he might not want to invest into iPro value discovery. He might want to go ahead with quant flexicap if he's, of course, okay with assuming higher levels of risk, right? On the other hand, if the funds get plotted, parallelly above each other, then the choice becomes fairly simpler, right? For example, choice between a Bandhan sterling value and UTI value is fairly simple, right? With the same level of risk, that's 10% for Bandhan sterling value and again 11% for UTI. I'm getting a better return in with respect to Bandhan sterling value. So I will, if it's a parallel comparison, if the funds are getting plotted parallel line, then I would definitely choose a fund that appears at a height than a fund that is appearing or getting plotted at a lower level. That's because with the same level of risk, I'm getting better return. Right? This is how you can use this risk versus return scatter plot to understand risk and return positioning and actually make choices. Of course, you can play around with changing the start and end dates. Again, there was a feedback that we had received from a lot of our clients that all of this reading these numbers gets little challenging at times because you have to hover on this particular plots, only then these are visible. And we have taken that feedback and we have now introduced an Excel download option right here, wherein if you download this into an Excel sheet, it will show risk and return columns simultaneously, adjacent to each other, and of course, list of funds. So I'll show you how the export looks like because this was a recent addition. So you see, I hope my Excel sheet is visible. And you see a list of funds right here, their risk scores, risk numbers, and of course, their return numbers. So this will be visible now onwards. This is the risk and return statistics. So this is typically what I wanted to discuss on the webinar part. Now we can throw the forum open for a Q&A session. If you have any questions, please feel free to directly unmute yourself to speak or directly type in a message in the chat box. Thank you. Okay, so there's a question in the chat box. Is there an option for multiple users to use engine simultaneously? No, currently that's not something that is possible on engine. If simultaneously two logins are made, you will get a pop-up, right? If you want to stay or you want to log out. So you'll be typically thrown out of the system when simultaneously a user tries to sign in at another end, right? So at one point of time, only one person can access one login. Any further questions, please let us know.
Just tell me one thing.
Yes.
Can you hear me? While
Yeah, please
selecting
go
the
ahead.
funds,
Question?
yeah, you have done a selection for launch date, like 2000 to 2024. Just simple suggestion that any fund which is launched prior to that, it will not be shown in the database.
No, no, no. So basically, I put that as a condition. Of course, you can change that, right? You could keep it to 1993. This was just a
Means
condition that
ideally,
I took.
ideally we should not change the
Sure,
from date. It
sure,
is
sure,
always
sure.
suggested that we should change that
Of course.
end date.
And understand. I get your point. Yes, you could definitely do that. Yeah. So maybe we could completely remove that condition, and then we can change the end date so that we can exclude the younger funds. Yes, point
Yes,
taken.
absolutely.
Yes, yes. Point taken.
Thank you.
Okay, if there's no other questions, we can end for today. And also, please just show the place where we upload the webinar. I think there was a comment about sending the recording through.
Yes, absolutely. So, thank you for joining in. We have a list of all the recorded webinars uploaded on our YouTube channel. You will also see this webinar recording uploaded by next week. So the webinar recordings can be found right here. There's a link for our YouTube channel. You simply click on this. There's a dedicated playlist that we have created for all the webinar recordings. You can go to this playlists. And this is the webinar recordings. Already 113 videos have been uploaded. You will see even this webinar video uploading in the next week. So thank you again for patient listening and have a great weekend ahead. Thank you so much.